This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. I'm Terry Evans with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. It's the Wealth Roundup for the week of April 3rd, 2026. Back from a little break over Easter with the kids and family. Patrick, good to see you. And it's been an interesting couple of weeks since we last spoke, and actually the first quarter now as we record this. It's the final day of March, and we're looking at some interesting things. Year to date, we're up a little bit, but this past month, down about 5%, and we probably can figure out why, right?
Yeah, I think we've kind of joked before that in the past, when either you or I have taken a holiday, is that we usually come back and the markets have been great. So had a little bit of a break there for spring break, and things in the Middle East didn't get any better. So we're likely going to close off the month of March, and it will be our first negative month of the calendar year. But you're right. The TSX, as we tape this podcast, is actually still in positive territory on a year-to-date basis. Slightly up, just about 1.5% year-to-date. Up today, when we look at the S&P 500, actually up today. And I'll have to admit, when I went to the gym after the office yesterday, and the CNN feed of the burning oil tanker in the port of Dubai had me very concerned about how the markets were going to open up this morning. So I was very surprised when U.S. futures were still pointing positive, and actually U.S. market up today about 1.5%, but still down about 6% year to date. Oil prices at 104, so up again today. Recall that before the Middle East conflict started, we were trading at about $70 oil, and the Alberta budget for the fiscal year starting April of 2026, we were actually using $60 oil as our forecasted average price for the year. So in all likelihood, the average price with regards to the budget is going to change, probably higher in reality as compared to what the budgeted price will be. Gold today, up strong, up about 2% at 46.11. Recall that we started off the year on gold at about 4,400. So that's one of the asset classes still up today, or still up on a year-to-date basis. Bitcoin is kind of flattened out a little bit, still trading around 67,000 US. And I think notable that bonds, so we would, often talk about bonds as a safe haven asset, is that bond prices on a year-to-date basis are down about 1%. And the US dollar has also reversed course compared to, where its earlier trend was during the years, that the US dollar is up about 1% versus the CAD and about 1.5% versus other currencies like the pound or the euro.
You talk about going to the gym and, to get your workout. And if your face needed a workout because of all of the muscles in your face, I suppose that the facts and the impact of the war in Iran are probably enough to give your face a workout, because like every day or every afternoon, you're like, oh, your eyebrows are up, your eyebrows are down, your furrowed brow. What are the impacts on our investments here because of the war in Iran, aside from what you just mentioned with today's markets?
Yeah, so, it really depends kind of what time of the day you're checking on them. I was just kind of talking to, our longtime receptionist that we have here at the office, Karen, and I said, you could ride the elevator down to the lobby, grab a coffee, and come back, and it could be a whole different story in the market, especially if you're working off of a delayed feed, which a lot of media sources do. They work off of a delayed feed. I think what we are seeing, or let's just say what we know, is that we know that 7.5% of world oil supply is disrupted. So very significant. We know that with oil and energy prices being higher, is that we can expect inflation to trend higher. But it's not only energy. There are a lot of commodities that are shipped through the Strait of Hormuz, which are very important to the global economy. So, big time suppliers of fertilizer, aluminum, and industrial gases like helium come out of the Middle East. And so, when we think of some of the key themes that we were talking about this year with regards to the build out of AI infrastructure, which is going to require a lot of energy. And it's not only AI, with quantum computing and cloud computing, is that all of these things are going to take mass amounts of energy. And so we have definitely that higher cost of energy is going to impact the net profitability of a lot of those projects. So when we think back to our December 24th podcast, which I think was episode 26, we were kind of talking about a year, a forecast for the year, is that we have to kind of start taking a look at those forecasts and now modifying those forecasts.
With the things that you were talking about just then, the things that you do know, the facts that you have on hand, and aside from the few things that you just mentioned, are there other specific things in the future that we should be looking for that you are anticipating?
Yes. So I think the first thing that we have to think about is, what does this mean for interest rates? So when we think of how, say, the central bank in Canada or the Federal Reserve in the U.S. is now going to react to this new normal. So if inflation was ebbing down, and inflation ebbing down allowed, say, the Bank of Canada to hold rates, which was what our forecast was, or with the U.S. to lower interest rates, and we were expecting interest rate cuts out of the U.S., which was kind of late to the game in terms of cutting interest rates, is that we have to revisit some of those expectations, and where global interest rates are at affect the valuation of financial instruments. So if we have perhaps higher inflation, but at the same time, we maybe have less economic growth, which certainly could potentially be an outcome of an event like this. For example, higher energy prices, which, like, say, factor in everything from filling your car to powering your home to heavy industry like mining and production of plastics, is that all of a sudden a lot of the consumer staples, so things that we have to buy because we have to consume, versus the things that we want to consume, so some of our discretionary expenses, is that we would expect that consumers will probably have to make some tough choices. And so that also ends up factoring into what we would expect from stocks during the year. So what we're seeing kind of playing out in the market is that investors are sitting on some of their savings capital. So, cash is kind of one of the few kind of safe havens, other than we kind of talked about, gold has turned out to be positive. Canadian equities have turned out to be positive. Most energy assets so far on a year-to-date basis are positive, but cash has remained positive. So savers, making the choice to invest or to maybe sit on some of that cash, are we're seeing those cash levels go up, and maybe kind of compared to, say, when we went through the COVID crisis, is we had super low interest rates at that time. In the spring of 2020, interest rates got slashed practically down to zero. If you're going to hold on to cash, you weren't making any money on cash. Whereas right now, you're still probably making 1.5% to 2%, on a Canadian T-bill in cash. So cash isn't a terrible place to sit this out. And then I also think that investors that either have to sell because they need some cash for something, or just want to sell, are probably looking at their portfolios, and intrinsically you think, oh, maybe sell what's down. But actually, it's not necessarily, this wouldn't be necessarily intuitive, is that investors are kind of forced to sell quality in their portfolio because they'd much rather sell something that's not down. So if we take a look at, say, the NASDAQ, which would have a higher concentration of growth stocks, it's down about 8% year to date, whereas the Dow is only down about 4% year to date. If we look at the Canadian Bank Index, there's actually an ETF you can track this, ZEB, is that you'll take a look at that and you'll see that the Canadian banks are about flat. So, an investor that, has to, say, find $10,000 in their portfolio for something, are they going to sell their growth stocks, which are down 8 or 10%? or maybe temporarily sell some of their Canadian banks or their Dow stocks, their more value orientated stocks, because then they're not going to realize as much of a loss. And then they can wait for some of those growthier names to recover, over the medium term, perhaps once this conflict is not as severe or significant or as front of mind as it is today.
As a portfolio manager, just relating to some of the things that you were just discussing with relation to what people have in their portfolio, how much of it is managing anxiety or helping people navigate their investment impact because of the events that are taking place?
Yeah, so there definitely is some hand holding. There's some reassuring clients that if we've done the work in advance, we shouldn't have to maneuver in a way that would show that we're panicking. Is that we should be able to just kind of follow the plan. When I think of probably the most common asset allocations here at Leonard Wealth Advisory is it's either a classic portfolio where 40% of the portfolio is in bonds, or 60% of the portfolio is in stocks, or our growth clients that are approximately 25% in bonds and 75% in stocks. And so when we look at how those clients are doing on a year-to-date basis, a 40-60 model, we're still actually positive on a year-to-date basis, about 1.5%. And a growth portfolio, they're only down about 2% on a year-to-date basis. So, looking at the headlines and saying, the S&P is down 6% or the NASDAQ is down 8%, a client that's, properly allocated, balanced, and has a diversified portfolio between stocks and bonds and maybe some commodities like gold, is sitting in much better shape relative to the indexes. So now, if things always do come up that are unexpected, so unexpectedly, maybe have to put some new money to work. So where would we be putting that new money to work? So very much, focusing on quality. We would expect earnings season to start here in about 3 weeks. We expect earnings season to be relatively good. Guidance is probably going to come down a little bit, but generally the businesses that we liked a month ago, we still like those businesses today. We are benchmark weight with regards to stocks and bonds. But if we had some tilts, we would favor North American equities, over international equities, largely because North America is self-sufficient when it comes to energy. And with regards to bonds and fixed income, we've been short, kind of average duration for quite some time because of some uncertainty about the direction of inflation. So if the Canadian Universal Bond Index has an average term to maturity of, 4 to 5 years, we're sitting at closer to 3 years right now. So that if we get an unexpected interest rate decision or we get an unexpected move in inflation, is that the change in valuations on bonds will be less significant. So I guess the key message is here is we're not changing how we look at the market opportunity, but we would encourage our clients to do a couple of things. We actually have a Middle East client webcast tomorrow. So for our clients that haven't signed up for that, they can email us to get the link. That's going to be a live webcast event. Would certainly say that. And then any other questions that they would have or concerns is to direct them towards me or my team.
With that live webcast, is it going to be recorded and available for people who maybe hear this podcast after the fact?
Yes. So I don't have the details on when that replay will be available, but I would expect that usually about 4 to 5 business days after a live event, we have it available to send it out as a link.
Perfect. For wealth management and to start your investment journey, you can find Patrick's contact information at www.patrickmleonard.com. Please follow, share, subscribe, and comment if you so desire. Thank you for watching the Wealth Roundup for the week of April 3rd, 2026 with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns.
Thanks, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.